So today we are going to be going over, kind of resume where we left off last time in the part 1, chapter 7 notes. We're going to be talking about the adjusting entry to our accounts receivable, which is estimating bad debt expense. We're going to be talking about the allowance methods of doing that. I'm going to just highlight quickly what it would look like to do a direct write-off method instead. You should be somewhat familiar with that as well, just to compare the two and to understand why the allowance method is what GAAP prefers. We're going to talk about the new standard for assessing bad debt, which falls under something called CECL, C-E-C-L. It's the current expected credit loss. It is something that was just initiated in 2020. Companies are still sort of figuring it out. It has more impact on industries with heavy investments, less impact on any other sort of company. So we're talking about financial services, banks, bank holding companies, savings and loan institutions, to some degree, companies in the insurance industry. Those are going to be affected a lot by CECL, but it will have some effect on trade receivables as well. Remember, trade receivables are simply amounts of money owed to us by our customers for goods and services purchased on credit. And hopefully we'll get into some sales return stuff today. So let's go ahead and get started. I'm going to switch over to my camera and we'll start going over the notes. When we're working with these, we're trying to get that straight. All right. So when we're working with the allowance method, and again, this is the US GAAP approved method. It's preferred to the direct write-off method. At the end of each period, whether that be a quarter or a year, we have to estimate the expected loss of what we're not going to be able to collect. So we have to estimate our bad debts, the people that have purchased on credit that we do not believe are going to be able to pay us back. So these are our uncollectible accounts. Sometimes they're called doubtful accounts. So either terminology refers to the same thing. Basically, someone who is going to be unable to pay us back, it's a bad debt. And we're going to create it, we're going to estimate them by using an adjusting entry. And so I'm highlighting the fact that this is an adjusting entry. Almost any estimation that I can think of in an accounting system is an adjusting entry. And when we make this adjusting entry, we're going to debit bad debt expense for the amount of our estimate, whatever amount of dollars we deem that to be. And then we're going to credit the allowance for doubtful accounts. So what we've got going on here is a reduction to net income. This is the bad debt expense part. And then we also got a reduction to assets with the allowance for doubtful accounts. Just to give us a little bit more context, because we are adding to, our knowledge about how things are compiled on the income statement. Bad debt expense would be an operating expense, and it would be really something tied to probably kept, depending on the company, but most companies would put it within that catch-all selling expenses, because it is an expense of selling things, right? I open my sales to people being able to pay me in the future. And because I do that, I will most likely expand my sales. However, there are certain expenses that come along with opening ourselves to credit sales as a company. One of those potential expenses is that folks will not be able to pay me back. My customers will not be able to pay me. They will default. They will become bad debt expense. So here's just some names: allowance for bad debt, allowance for uncollectibles, allowance for doubtful accounts. All those things are the same. Notice almost all of them use the word allowance. This is a very common term that we use in accounting for an estimation that is a contra account. It is a contra asset account. So when we think about how it's constructed with a T account, it has it's contra asset, and therefore it's opposite to the rules of assets. It's increased by credits, it's decreased by debits. And all it represents is a running estimate of bad debt in our current receivables. And its role, remember, is to offset accounts receivable when they're reported on the balance sheet. So when we're reporting something on the balance sheet, if this is just a single account, excerpted from a balance sheet at 12/31/22, we got our accounts receivable net of allowance. And what that means is what this number actually is that's reported, this dollar value, it'll be the ledger amount of my accounts receivable less the ledger amount of my ADA. So it's net of that. We subtract it off. That way investors get a relevant idea of what we expect to be able to collect from all of the people that owe me money. It would not be as relevant to know that I have $1 million of receivables if I just have, for example, very loose credit terms. I basically make credit sales to anybody and don't, check their worthiness or, new people that I've never dealt with before. Maybe like 20% of those are going to go bad. Then knowing that I've sold things $1 million of merchandise or services to people would not be as relevant as understanding that I only expect to collect 800,000 of that if 20% are going to go bad. So this allows me to give a little bit more relevancy to the measure and report that relevant data to my shareholders. Remember, this is just an estimate, and until it's proven a truth, until I actually can identify the person whose account I need to write off, it stays an ADA. It's just like, yes, I think that $200,000 of my receivables are probably not going to be collected. I don't know who they are. Right now, they're just in my ADA. And until I have some verification, then they're going to stay in my ADA. But once I have the actual uncollectability established, it's in fact uncollectible, I'm able to identify the customer. It's no longer just an estimate. Then I write it off. And this, folks tend to get the first estimate, but then they get a little bit more trouble with the ADA and the accounts receivable. Remember, all I'm doing is now reclassifying it. It's no longer an estimate. And so I reduce my allowance for doubtful accounts with a debit. Remember, debits decrease my allowance for doubtful accounts. And I write off the actual account owed. So I reduce my estimate and cancel individual customer account. And that's also that idea that, well, now I've identified the particular account of the customer who can't pay me any longer. I can actually credit the accounts receivable for that. And so what happens as I reduce the allowance for doubtful accounts, it actually increases my assets because this is a contra asset. So the bigger it is, the more my assets are reduced. The smaller it becomes, my assets start to go up again. So I increase assets with that debit and I decrease assets with the accounts receivable. So there's no net movement, no net change to assets, and no net change to my NRV. Remember, NRV, net realizable value, is just this amount right here. It's the accounts receivable account less my ongoing estimate of what is doubtful. And if you kind of just, you can work through, and I always as a student, I would prove to myself with simple numerical examples when I wasn't sure about something, because people are like, well, why wouldn't it reduce my net realizable value? I know someone's bad now. So let's just take the example that if I had an account receivable balance of $10 and I had an ADA of $2, and I've now identified someone who is unable to pay, right? I write them off. So let's say it's a $1 write-off. I credit AR by $1, I debit ADA by $1, I reduce them both. Okay, now I can do a comparison. What was the net realizable value prior to the write-off? So prior to the write-off, it's these two numbers here, 10 and 2. 10 minus 2 is 8. After the write-off, what is my net realizable value? It's 9 minus 1. 9 minus 1 is still 8. And so that is one of the advantages of the allowance system, is that because we're estimating these items in advance, when they actually happen in reality, the net realizable value of what I'm reporting on the balance sheet does not change. So there's no surprises in those changes. The other item I want to talk about is, in terms of the allowance method being GAAP approved, one of the reasons that it is GAAP approved is because it is an instance, again, of the matching principle. So we do not want revenues that are generated to be recognized separately or in separate time periods from the expenses that are associated with them. We want any costs that are incurred from producing a revenue should be reported in the same period as that revenue. And so if we make credit sales during the period, it means that I've recognized revenue. And even though I don't know, perhaps at that moment, which of the revenues, which of the sales I made that are going to go bad, I still know that some are going to go bad. And so what that implies by the matching principle is that I need to recognize bad debt expense in that period. I don't want to wait until I have a notice of default in order to recognize the bad debt expense. And that's why the allowance method, estimating what's going to happen ahead of time, is in line with GAAP. The direct write-off method is not, because the direct write-off method does not recognize the expense until we know it's a default in fact, until we know the exact person that would have defaulted. And, you know, as an example, or just to kind of look at the two side by side, the direct write-off would not estimate any bad debt expense. So that this whole entry would not exist under direct write-off. It does under the allowance method. Under the direct write-off method, that bad debt expense would come in here when we have the customer notify me that they're unable to pay. Then I would debit bad debt expense and credit my accounts receivable at that time, which creates at that time the net income effect and reduces my assets. So we give some forward-looking information by using the allowance method. When write-offs occur, it doesn't change my overall NRV. We are applying the matching principle when we use the allowance method. We may not be matching correctly under this method unless the notice of default happened in the same period as the credit sale. Any questions about how to estimate that, or the ideas behind estimating that, or anything I just said?